You've been paying into that long-term care insurance policy for years and years. And if your financial situation has improved, you might be wondering whether you still even need it. In this video, we're going to go through an exact case study of someone in that situation who's approaching retirement, has a long-term care insurance policy, but doesn't really like paying the premiums and is wondering if they can dump it before quitting their job and stepping into retirement. There are reasons you might want to do this. There are reasons you might not want to do this. We'll cover them all in this video. So in our example, we're going to assume that there's a single individual who's 65 years old and just about to transition into retirement. We're going to plan for a 30-year retirement timeline, meaning that we'll set their life expectancy at age 95. Now, I'm a big fan of the show Seinfeld. We're going to assume this is Jerry Seinfeld, who might actually be around the age of 65, although he has a lot more money than this. We're going to assume that Jerry is going to spend $10,000 per month in today's dollars. That amount is going to increase every year at the rate of inflation. We'll assume that Jerry has $1.5 million saved up in tax-deferred pre-tax retirement plans, 401ks, IRAs, those kinds of things, and another $500,000 saved up and invested in taxable investment accounts. So real quick on inflation, you're probably thinking of our projection as being way too low, 2.56%. There's no way it's that low. Well, here's a chart of what the inflation numbers have looked like over each of the last 10 years. You're right that over the last 5 years, inflation has been much higher than 2.56%. But remember what happened before 2021? Inflation was much, much lower since the depths of the financial crisis. This chart only goes back to 2015, and the average of just these 10 years is closer to 3%. So when we take a long-term look at this, inflation's actually been quite a bit lower than a lot of people realize. It's a little bit higher today. Moving forward, maybe it goes up. We don't know. But the long-term rate of inflation is really a hair north of 2.5%. Now, for Jerry's asset allocation, here's what we're looking at. We're assuming he's got a really moderate portfolio. Half of it's in equities, half of it's in bonds. You see here that our allocation to equities is a little bit less than 50%. That's because we've parked 3% in other stuff that's investment real estate, which is kind of an alternative asset class. So this is a really balanced portfolio. It includes U.S. and non-U.S. stocks. It includes short-term and medium-term bonds in the U.S. and outside of the U.S., and it's really, really diversified. Now, the rate of return that we might expect over a long period of time, based on how this kind of mix has performed in the past, is about 6.75%. So we're assuming in Jerry's case that he's going to pull about 6.75% per year on average out of the portfolio. Obviously, there are going to be some years that are far below that and other years that are far above that. That's how this stuff works. But on average, we're assuming around 6.75%. Now, we're also going to assume that Jerry collects Social Security starting at his full retirement age of 67. He's 65 now. Let's assume that he waits to file for his benefits until age 67. When he does, he'll start collecting $3,689. Again, in today's dollars, they'll go up at the rate of inflation. It works out to about $44,000 a year. In addition, his long-term care insurance policy is one where he has up to 5 years of benefits, $100,000 per year that he can claim from this policy if he needs it, and he pays $5,000 per year into the policy in the form of a premium. Now, we're also going to assume that both the benefits, the $100,000 a year he can pull out of the policy, go up at the rate of inflation, as do the premiums he pays of $5,000 per year. So let's take a look at our baseline projection here just to get us started. What we're looking at here is Jerry's projected portfolio value in each of the next 30 years if he just gets the average rate of return. So it's a little bit more complex than just applying an average annual growth rate to both of his accounts, because remember, he's getting $3,600 of Social Security income. He has $10,000 of expenses each month, which means he needs to pull about $6,400 out of some of these accounts. And typically what you want to do is take them out of taxable accounts before you start taking money out of tax-deferred retirement accounts. So it may be a little bit more, a little bit less, depending on the taxation and the timing of these distributions. In all cases, he gets to age 95 with some money in the bank, Keep in mind, this is just assuming he gets the average rate of return every single year, which is never going to happen. So if we do a 1,000 trial Monte Carlo analysis instead, that includes the probabilities of having really good investment returns versus really poor investment returns, he gets to age 95 with money in the bank in 620 of these 1,000 trials. And in the other 380 trials, if he doesn't make any changes, then he works his account balances down to zero. Now, realistically, there are a couple things that we need to be reminded of. Number one, nobody on earth is going to keep spending the exact same amount. Well, maybe not nobody on earth. Most people are not going to spend the exact same amount until they work their accounts down to a zero balance while they still have life left. Most of us are going to make some kind of adjustments, either to how we're investing things or how we're spending or how the rest of our financial plan is working. We're assuming that there are no changes and that Jerry just burns everything right down to a $0 account balance. The other thing is, remember, this is just looking at portfolio assets. It does not include the equity in his home. And if Jerry really got in a pinch, he could use that equity maybe in the form of a reverse mortgage or something else if he really needed it. We don't typically like to start there, but it is available if he needed it. Now, Jerry has this long-term care insurance policy. And if he needs to use it, remember, he's paying $5,000 a year into this policy. That means that in the early years, he's going to continue making these premium payments, but then most of the cost of the long-term care is going to be covered by the policy in this circumstance. And so if we're just considering these base facts here, I would think that Jerry probably wants to keep a hold of this insurance policy, because his portfolio assets are already kind of dwindling into his mid-90s. He probably doesn't have the resources to self-insure, meaning pay those long-term care costs out of pocket without the use of the long-term care policy. Now, if we dump the long-term care policy, then obviously in these early years, he's going to save money on the premiums. He doesn't pay $5,000 a year into the policy, meaning he has to take $5,000 a year less out of his investments. That's why those columns show green and they get a little higher in the early years. But then look how dramatically they drop off after he has to start paying for these long-term care expenses. And in fact, he gets to age 95 and he works everything down to zero. Now, to the Monte Carlo, if we need long-term care help, remember we started at 62% by keeping the policy, but not needing to make any claims against it. If he keeps the policy, but now he needs 5 years in a nursing home or other long-term care expenses that cost $10,000 a month, like we talked about, netted out to $7,500 increase in expenses every month, then his probability of success here goes down from 62 to 61%. Now, typically 62% is a little bit lower than where we want to start, but it's not that far out of the ballpark. So if he needs the help, he's really not in a terrible position if he hangs on to the policy. If he dumps the policy and he needs the help, obviously that's going to go down, right? Not in a totally crippling way, but we're a little bit closer to a coin flip than we'd really like to be. If he dumps the policy and doesn't need the long-term care assistance, now he's actually looking pretty good. But at the outset, if we're not considering the value of the house, I don't know that I'd be too comfortable getting rid of this policy if I'm in Jerry's shoes. The wild card here is what happens to the equity in the house, right? And remember that we're not assuming that Jerry spends any less over the course of his life. I've never met anybody who's in their 80s that spends less than they did in their 70s. So that's a little bit unrealistic too, but we're going to be conservative and assumes that he continues spending $10,000 a month every year through age 95. Well, if he needs long-term care, usually what that means is you're moving out of your house and into a long-term care facility, either independent living, assisted living, memory care. As you know, there are a lot of variations of this, right?
And as we see, that means that his portfolio assets go down a little bit, but he has the policy and it's not crippling. What I'm getting at is a lot of people build into their plans that if and when they need to move into that assisted living or independent living environment, that's when they're going to sell the house. And that equity can be used toward these costs. Now, you're taking a little bit of a risk there. It is a bit of a gamble because you're assuming that the real estate market is in a position where you can sell the house for what it's worth at the same time that you need to move into one of these facilities. But again, perhaps a reverse mortgage can be used in some circumstances. So if Jerry needs the long-term care help and he makes that move and sells the house, then he's in really good shape. And if he dumps the policy, it appears to me that he's probably going to be okay as long as he's comfortable using the equity in the house to pay for those out-of-pocket costs. So let's go through this from the Monte Carlo perspective. If he hangs onto the policy and does not need to use it and sells the house when he's 95, then his probability of success goes up to 78%. But as you're probably thinking, well, hey, he needs to live somewhere, right? So in this circumstance, maybe he's going to live with a family member for the last few years of his life and not pay any rent, something like that. If he sells the house at the time that he's moving into a long-term care facility and he keeps the policy, well, hey, he's really not in that bad of a position. And if he dumps the policy but plans to sell the house, he's not in that bad of a position either. So what I would say in Jerry's situation is that it really depends on how important it is for him to keep the house. Now, if Jerry were married and he wants to make sure that his spouse can remain in the house, if he needs to move into an assisted living kind of situation, that's a consideration. Maybe if he wants to keep the house in the family and bequeath it to his kids or other family members, that's a consideration as well. But my point is that home equity is convenient and can be used toward these long-term care costs. Again, it's a little bit of a gamble because you're assuming you can sell the house, get cash out of it at the same time you need to move into assisted living. But it's something to consider when you're going over whether or not to keep your long-term care policy.
So there you got it. The decision of whether to keep or to dump the long-term care policy in Jerry's case depends a lot on what he really wants to do long-term with the house. Now, the other consideration here is that, remember, these are all just projections and a lot can happen. There's no guarantee that premiums are not going to change. There's no guarantee that the cost of long-term care doesn't go up way more than we expect it to, or the markets produce far lower returns than we're expecting, or other things happen in Jerry's life. These are just projections, and the decision of whether to dump any kind of insurance policy or hang on to it, if you're really right there on the borderline, if you're not sure what to do, dumping it is a pretty heavy decision. So make sure you're confident before you get rid of that policy.